We want to welcome everybody to our series that we've been doing here about tax credits and how that works and cash flow that can come from that. Tax-free cash flow is kind of what we decided to call it because, well, neither Larry and I are literary geniuses, but we decided to name it after what it was. And really what Larry and I have learned, over the years is how to take advantage of the tax code to make sure that your buying power goes farther, your spending power goes farther, your earning power goes farther. And that's why we came up with this series. And to kind of give you guys a background on who I am and what I've done to get here, my name's Shannon Robnett. I am a second generation builder developer, fourth generation realtor, third generation pilot, first generation school. I've been doing a lot of things in the real estate space for a long time. One of the things that I've done is I've studied a lot on the tax code and how to be tax advantaged. And I did this because I was frustrated with what my accountant wasn't telling me about. They would always agree with me, but they would never tell me. So that's when I met, that's right, Larry. That's when I met Larry. And Larry was the first of his kind that I've ever met that really understood how to be proactive about what your tax situation is so that you can make the most of it and be very tax advantaged. So Larry, tell them about your journey and how you wound up here.
Yeah, absolutely. And before I jump in, Shannon, I just a quick reminder: hit the record button so all of the people who couldn't make it today can check this out later. All the fun gems will drop.
Recorded, my friend. It was recorded before you ever showed up. So now we're going to see one more example of Shannon's right and Larry's wrong.
Touche. I'll take you on that one. So how did I get here? I spent the early part of my career doing the traditional thing that accountants do, right? You learn a little bit about tax, you get stuck in a tax shop and you just pump out tax returns. But quickly I realized that tax returns themselves weren't really the value proposition. A lot of it really revolved around the strategy and planning piece. And that's where I started to cut my teeth. I really dug in and started to understand how the tax doesn't have to be just black and white. I'll say it that way. There's certain strategies that you can apply to still achieve the outcome that you're looking for, and that's essentially the world that I play.
And Larry and I started working on stuff because we saw the ability to work together to put people in a position where their tax strategy was half of their investment strategy. When you look at it, being able to save 30 to 35% on your taxes adds a lot to your buying power. Now, I met Neil, all jokes aside, I met Neil about a year and a half ago through another person online, really. But Neil, you've got a different investing strategy. You've got one that definitely takes advantage of taxes. And what we want to do is we want you to introduce yourself, obviously, and then we want to talk about what it is you do. And then Larry and I are going to interrupt you like the two guys on the Muppets sitting up in the corner and talk about the tax strategies along with how you do your investments and what your particular flavor is.
Absolutely. So Neil Wahlgren, and first off, thanks for having me on, guys. Really enjoy getting to have a little banter here and talk a little about real estate and life and love. But Neil Wahlgren, I'm a California native. Kind of born and raised in NorCal outside of San Francisco. I reside in San Francisco now. Previous career as a Air Force pilot. So went to the Air Force Academy, Air Force officer, and ended up going through flight school and flying C-130s for about 8.5 years with the Air Force, and then a couple more years with the Navy Reserve. So that took me all over the world, kind of ignited that early flavor for travel and experience, and frankly is what kind of drove me eventually into the world of passive investing, where you can kind of combine active passions with residual income coming in and tying in tax benefits that we'll talk about a little bit here as well. So after a flying career, ended up joining a couple of startups and eventually transitioned over to the commercial real estate world of it, initially on just the money raising side, and then working and partnering full time with Mag Capital Partners. So I'm one of 3 partners here. I run the investor relations and capital markets side, where once we lock up deals, myself and my team are responsible for really the money raising and debt placement to effectively close on the properties that we've acquired and got under contract. So,
Now, if remind me though, one of those other partners is your brother, right?
two founding partners, Dax Mitchell and Andrew G.
Okay.
But my brother Drew joins me as a executive VP
Okay.
on the capital raising side.
I knew that, and depending on which one you ask, guys, there's the argument about which one's the more handsome of the two. But I'll leave that between the brothers. In fact, that's how your brother introduced himself on an email.
Handsome Drew, right?
I'm Neil's better looking brother. So anyway, so Neil, tell us a little bit about your investment strategy. What genre are you in? What are the deals you're looking for? What's an ideal scenario for you?
Yeah, so I'm at Capital Partners. We've been around since 2015 and really carved a niche, primarily focused on manufacturing, tenanted, industrial, warehouse real estate. So what does that look like? Frankly, I'm kind of blah type of real estate. It's going to be four walls and a roof. And really what's unique about the asset class is the emphasis is far less on the building itself, but far more on the lease contract with long-term triple net structured, manufacturing tenanted tenants that are providing consistent passive cash flow through rents, while offsetting all of the operational risk and expenses of a gross lease.
And that's funny because everybody right now, I mean, when you talk about blah, right now the world is on fire about multifamily, right?
Sure.
I mean, I don't know if you ever get people to go, oh, I thought you guys did multifamily. Do you know anybody that does? But, I've been involved in industrial for 25 years. That's really what I cut my teeth building, was industrial and that kind of space. But, what's so blah about it? I mean, you get tenants where you own where they reside, in the multifamily world. So you get to have their fights there. You get their kids running around there. You get cartoons drawn on the walls from their, you've got the daily wear and tear and the beat up on the place. You've got the tenancy turning over every single year. They have no credit or they had already bought a house. I mean, what's blah about what you're getting versus this exciting world of multifamily?
No, you hit the nail on the head there. We've set up an investment structure where, to be honest, all that craziness still happens, right? You have, tax reassessments change and your insurance premium shift and, unexpected expenses like roof replacements and HVAC repairs happen. But based on that long-term triple net lease that we set up with our tenants, all that, quote unquote excitement gets to be handled directly by our tenants. So from a landlord, owner, investor position, that really income just boils down to rent comes in, we pay the mortgage on our commercial debt, and the rest is distributable cash flow.
So, Larry, let's talk about the tax side of this. Neil's acquiring this blah real estate, right? I mean, there's not a whole lot to it. You've got a single tenant in most cases, right, Neil?
Absolutely.
You've got credit behind it. So you've got a signature of somebody that's got a net worth. They've got a value of a business that's inside of that. Neil, do you make them do the assignment of the equipment as collateral on the lease? I mean,
yeah, it's really going to come down to the strength of credit. And that is where your risk lies on these. Effectively, most of these are privately held companies, so they're not public. They don't have public financial disclosures. So we have to kind of do the research ourselves. So we have an in-house credit team, 3 guys, fantastically talented. They come through, and every deal that we're looking at, once we kind of put in an LOI, that allows us to look under the hood, look at audited historical financial statements, and really get to see, hey, what is the true strength and quality of the financials of the entity that's signing the lease. And our guys will come in, look at that. And frankly, they are making an assessment to go, for the next 3 to 5 years, we plan to own this real estate. Do we feel these guys will A, stay in business, and B, comfortably be able to pay the rent? And if we feel good about that, that is the kind of financial due diligence that's primarily looked at going into a deal like this.
So Larry, when we're talking about triple net deals, and one of the things that's the big thing in multifamily is all the expenses and how you're juggling that, and you're trying to price that in. Is there any advantage tax wise to making all that the tenant's responsibility? I mean, that how does that work with my pass through income if I'm not having to collect it, deal with it, pay for it? What's that look like on my side?
Yeah, I think it's less of the, and we'll talk about the tax in a moment, but I think it's less of the tax and more of an efficient cash flow machine. Because what happens is, as an owner, investor, operator, however we phrase it, you pass all the costs on. You essentially don't bear the burden of taking those on. And so even if you're paying for it from the operating side, eventually it's recouped from the tenant itself. And those two things net out. So you don't necessarily have a tax liability that's associated with it. Your biggest thing are, and Neil, correct me if I'm wrong, you're collecting rents. And we all know the power of real estate. You've got the depreciation that comes along with that, besides your regular operating things. So you've got cash flow, efficient cash flow at that, and you're paying little to no tax on that money.
So then, Neil, the if I could see a con here, it's that you have long-term leases, right? So how are you seeing those long-term leases perform? So you started in 15, 16, 17, we'll call those normal, right? 18 was normal. 19, things started to get a little weird, right? Sure. 2021 was full-blown costume show, right? It was weird with a capital W. Where we've been able to take advantage of that in multifamily with being able to reprice every year and really, make sure that we're maximizing that investment. You've got a long-term window here. You've got a long-term lease. How do you structure those rents adjustments in that lease that keep you up with CPI?
Yeah, no, great question. So on most of these projects, we are either renegotiating the lease or putting a new lease in play, specifically through what's called a sale leaseback transaction, where we buy the real estate from the manufacturing company and simultaneously lease it back to them. So with that new lease being put into place, our typical model is 2% annual rent bumps. So, from one side of the angle, you might go, all right, if inflation is say 4 or 5%, and I'm only going 2% up a year, am I losing money to inflation, or am I, effectively ending up with a below market rent? And that is a possibility. The flip side of that, I would argue, is our cash flow, our yield on these leases starts off exceptionally high. So, we're not a multifamily where, say, we're coming in with below market rents, 3%, cash flow to investors, where I need those big jumps to kind of get up to an acceptable cash flow yield. I'm typically starting around roughly 8%. So that 8%, I know I'm going to go up very consistently. I know I don't have any operational risk surprises. There are no, roof replacements or tax assessors that are going to impact that cash flow. All that risk goes to my tenant. And so if I start at an acceptable yield and continually go up, from our perspective, that's a fair trade-off. And then the other piece too is our tenants are really building their business around the predictability of known rent expenses. So their health and strength as a tenant is actually tied with being able to know and predict what the rent obligation is going to be 5-6 years from now. And that's important for them to stay a strong tenant that we can depend on.
And that's really what I'm hearing you say is, so when you do the value add, you're buying it, it's below market. Over the next 12 months, you're going to, redo the pool area. You're going to repaint it. You're going to give the tenants a reason why you're raising the rent a couple $100. And by the end of the first year, you're going to be at market. So you're stepping off. You're saying, hey, we're buying a building from an operational business. They've been in business with a track record. You've got all of this, and you buy the business on June 1st, and rents due July 1st, and it's already at market. So there is none of that renegotiation or that time frame that it takes, that loss to lease, if you will. So in that first year, you're really kind of taking that offset in, right?
Exactly, yeah. And we're actually, people don't sometimes discount that, and don't get me wrong, there's a lot of talented operators out there, but there is risk in that value add. You're taking an underperforming asset, often with multifamily, and saying, hey, here's my business plan. Here's the budget that I have for it. I think I can get it from A to B and do it within budget and in a certain amount of time. But that execution takes on operational risk that, you're really depending on the team and depending on, their, no big surprises to offset that. So here's a way to reduce some of that operational risk from a, basically known cash flow standpoint from day one.
The other side of that you're not having to deal with is we have in our models on multifamily, we have a 5% vacancy figured in. Do you figure that into your model as well?
Yeah, no, I mean, really, we come in and go, hey, this is fully leased. This is a, very strong tenant. And just for a little perspective, I mean, most of these tenants are, manufacturing firms that have been around 60, 70 years. Most of them do $100 million or more in revenue, strong EBITDAs, low debt. I mean, we're looking for fundamentals that have shown these tenants not only are healthy today, but have seen, probably a half dozen or more recessions and, upswings and downswings of the economy, and shown that they have the, really long-term tenure to get through those.
So Larry, I'm not seeing any write-offs here. I mean, you don't get to write down lost rents, right? You don't get to write off the tenant skipped town and left you with a house full of trash or anything. I mean, where's the tax advantages, Larry?
So I'm gonna throw this question over to Neil here for a moment. Traditionally, when you hear real estate, especially as you go commercial, industrial, multifamily, cost segregation study comes up right away. Is that something that you all use in your model, or is that something that you all just kind of kick to the curb and not even entertain?
We are what I like to say depreciation junkies. We love it. So every deal we buy, 100% of the time, we're doing cost seg studies on to take advantage of that accelerated depreciation. From our space, there's the core real estate. There's typically some attached equipment, typically cranes, 5 or 10 ton cranes on the building that can be depreciated, HVAC, a number of effectively attached equipment. And ultimately what that looks like from a investment standpoint, historically about 50 to 60% paper losses in the first year. And again, those are going to be passive losses generated from that depreciation.
So explain to me how cranes would work. Are they the same as a tool? Are you able to pull that completely out, or are you having to spread that out like a 10-year or a 15-year item like you would with carpet or something else like that in your cost seg study?
That's a little above my pay grade, down to that granularity.
Okay, well, we'll kick that one to Larry. Larry, how does that work with cranes and carpet?
Yeah, I'd love to see a cost seg study that includes those. I'd imagine it would be included as either a 5 or 7 year equipment, and that allows it to be accelerated right away in year one.
Okay.
And so I actually have a follow-up there too, because a lot of times when you're looking at real estate, residential, you have the part of the building, and that part isn't accelerated. That's left under its traditional structure, but you got these other components. So the type of real estate that you have, I mean, you talked about 4 walls and a roof, right? And a little bit of equipment. I'd imagine your cost seg studies are really, really robust, because most of that can be accelerated right away in the first year.
Absolutely.
So Larry, I've got a question on that. When you say 4 walls and a roof, are those the easiest to depreciate?
No, so usually those structural parts are what need to remain a part of the 27.5 years if we're residential, but 39 years if we're commercial. So those don't get segregated. So you want to keep those costs, that part of the segregation study, as small as possible. But when you look at what Neil does, or even hotels, the majority of what's segregated are pieces of equipment, 5, 7, 15-year items. And so those cost segregation studies are really, really robust.
I get it. So now I understand better, because you have more short-term items, you're taking more of that into the bonus depreciation realm. And whether it's 100% depreciation this year or 80% next year, it's still depreciation, and you're still able to pull that off and take that now.
And another way to look at it is, when you purchase that property, the percentage of that property that is the four walls and a roof is probably relatively smaller than what you might see in another asset.
Okay. So when you say, Neil, that you're a depreciation junkie, what are some of the other things that you, and we know that's not in a Charlie Sheen kind of a way. We know that that's more like, but
Tiger blood, right?
exactly. But what is it about that? I mean, what are some of the other things that you look at when you're looking at industrial that maybe other genres of real estate don't quite get the way that your business does?
So, I mean, and you mean all that tied in with depreciation side?
Well, what else? What other tax advantages do you see in the way that you guys do business? Maybe that's core to industrial that may not be there for office or retail or something of that nature.
Yeah, I mean, it's great questions. For all really all commercial real estate, you're going to have that, like Larry mentioned, that IRS, linear depreciation schedule. Anything non-multifamily is going to be 39 years, and that accelerated depreciation is going to shorten that. With industrial here, really there's two things to consider. You have your paper losses from that depreciation, and then you have your income. And really, we're looking for that kind of nice balance of, what we consider to be above market yield from day one, that's still fully offset by our depreciation. So, when you're able to combine true cash flow and have all or most of that cash flow tax deferred or tax free, that's kind of the sweet spot that I think we find in industrial that a lot of these other value add or a lot of these other multi-tenant type of commercial real estate asset classes don't necessarily have.
Awesome. And so when you're looking at that, what's your investment strategy? Are you looking to, I'm assuming that when you do these, you're negotiating a 10-year with a 5-year or a 10-year option on top of that.
It's typically a 20-year term with
okay.
2 10-year options beyond
okay.
that.
So when you're doing that, are you looking at a window to sell that asset in the 5-year term? Were they still enough left on the lease? I know that's kind of a thing with industrial, right? It's so law that nobody wants a short lease because then they got to go actually do something besides walk to the mailbox, right?
Our sweet spot, and by being the originator of these leases and putting a new 20-year term, that is actually a lot of our value add that we're putting on these investments. And what that allows us to do, typically we're targeting about a 5-year hold. So we can take 5 years of cash flow, 5 years of yield right off the top. And when we go to sell, when we sell that real estate, the lease and the remaining term are assumed by the new buyer. So that new buyer really is pricing or adjusting his pricing on that building based on A, the credit of the tenant at that time, and B, the strength of that lease and how long the term is. So, that new buyer is going to be saying, all right, I have 15 years of predictable cash flow left on this term. And he or she might only want to hold 5 or 7 years and maybe sell to a third buyer down the road. The closer you get to zero, the greater risk there is on that renewal piece, and you're going to have to discount the value of your property accordingly. But what we found is anything over about 10 years, you can still command a relative premium. So by putting 20 years of term, holding it for about 5, that says, hey, we can sell with a ton of premium. And even if say the market's a little wonky in 5 years, we can just hold a little longer. We can hold another 2-3 years. We always put on fixed rate debt. So we never are pinned against a wall, having to refinance or having to sell. As long as our tenant is strong, we can weather a lot of weird market abnormalities and still, say, hey, we're just going to hit the pause button for 2 years, continue to distribute cash flow, and then relook to sell maybe in 18 months. And that's, kind of a nice piece of the way these deals are structured.
And that's so true. I mean, I've been involved, like I said, in industrial for 20 plus years. And even in the worst of it in 2011 and 12, we saw very few vacancies. I mean, even when we saw people that we knew were the business owners, maybe not doing so well on the home front, they were still showing up at work because that was where their money was made. That's what they had to protect even more than their house. Right. I mean, they that's really legacy, yeah. Well, and that's where, that's how you paid the house payment. So if you had to let one thing go, you weren't letting the business go, you were letting the house go. Not that we had anybody that had to do that, but it's an interesting thing. Plus you have the whole deal there where you don't have to do much. I was in one of our units about a year ago, and I looked down and I said, "Hey," I said, "you changed the flooring in here." And he goes, "Yeah, I did." I said, "Didn't you need owner approval?" And he said, "Well, it said in the lease that I could have you do it and you would charge me to do it, or I could just do it myself and get the color I wanted the first time." And I said, "Touche, right?" So there's not a whole lot of ongoing expenses to depreciate or to take tax advantage of. But then again, maybe that's the beauty of the simplicity that we've all enjoyed.
Yeah.
I mean, I love multifamily because the cap rate compression is made for phenomenal investments, right? I mean, we make money on cash flow in the multifamily space, but we really make money on appreciation.
Mhm.
Where when you look at what's going on in the industrial world, in the warehouse world, seems to be a lot less to do with a lot more consistency, which would mean, Larry, we would need a lot less of your services to write down the losses that we took because the tenants didn't pay.
Well, when it comes time to exit after that 5 years, you'll come knocking. I'm waiting.
That's right. And that's the beauty of it, right? And that's why we like this series, is because we get to talk with experts like Neil and really hear what the beauty of industrial is. And that's one of the things, my father's retired a long time ago on industrial cash flow alone, right? Because of the simplicity and because of the fact that you have multi-year leases. You've got locked in tenants that have a vested interest in not only the building, but the community, right?
Yeah.
When you're dealing with these guys, I know I don't expect you to give us a secret sauce, but when you're dealing with these buildings and you're looking at that, how do you establish the value? Do you go out and get an appraisal and say, "Hey, your building's worth $10 million," or does the tenant say, "Hey, I want to pay $100,000 a year in rent," and you say, "Well, if you're only paying me $100,000 in rent, your building's only worth $5 million." I mean, how do you kind of come up with that? Because as we know, if it's a commercial investment, there's a cash flow component to it and a cap rate assigned in there somehow.
Yeah, no, these are great questions. So most of what we buy is through sale leaseback. And, ultimately you're going to start with a cap rate. And the interesting thing about these deals is it's kind of less dependent on a price per foot, but more dependent on the ratio and the relationship between price per foot of the real estate that you're buying and price per foot of the ongoing rent. So, and to use an example, right? We can come in, we can set a cap rate that ultimately drives the yield, aka the cash on cash that this investment will generate. I can say, all right, here's my target yield. And there's kind of there's really multiple solutions for how to achieve that yield. I can pay a lot of money for that real estate. And consequently, the seller who's becoming my tenant can pay a large amount of rent and I still hit that yield. Or that seller might go to me and say, "Hey, actually, I'm more interested in having a low rent obligation." So I say, "Okay, I'm going to pay you a lower amount per foot for this real estate and lease it back on a relatively low price per foot on rent." And both of those will still drive the same yield to myself and my investors. However, I can really tailor the price of the building and the terms of the lease to meet the needs of my seller who's becoming my tenant. So it's kind of interesting. And really, there's a lot more of, I would say, equilibrium, because you're not just fighting and battling it over price. I have multiple tools to really come up with more of a win-win with my seller in the terms of that rent variable that I can play with as well. So that's, kind of one really unique thing about this space with the sale leaseback component that I like a lot about industrial.
It sounds to me like you've got the owner, the soon-to-be tenant, negotiating against himself. I mean, the reality is, right, if I want $10 million for my building, then I got to pay all this rent. But if I'm willing to take 8, then my rent is lower.
Exactly.
Because now, so Larry, let's throw the shoe on the other foot. Let's talk about this from the owner's point of view that's going to become the tenant. I built the building for $5 million 20 years ago. Okay. I've depreciated the whole thing out, and I'm now maybe I'm getting ready to go second generation on this. My kids want it, but I really want my cash out. It's time for me to get, cashed out of the daily operation and sell it to the next generation. And I have this asset that I've depreciated. I have this equipment that I've depreciated. I have all this stuff that I've depreciated. And yet I want to pay myself for that and get my money out of the business. And so I go to somebody like Neil and I say, hey, Neil, I want 10 million bucks. And as an ongoing concern, we want, $100,000 a year rents. That's a 10 cap for those of you that are fast with math like me. And nobody's seen one of those in a long time.
Yeah, I was about to say, tell me where this is, and I'm it's my next call after this.
It lives with unicorns and Lucky Charms. But so we got this $100,000 a year rent, and I'm gonna sell. But if I went to the open market and sold the building, and I just went to where the market lives, I could get a 5 cap for this. So that same building, instead of $10 million, will get me 20. What would be the tax advantage to me, Larry, as an owner to sell at the lower price and receive a lower rent and have a higher profit in my business? What would be the advantages of that?
Yeah, so you'd initially be looking at the long-term play there, right? If you had a short-sighted or short-term view, you'd go with the latter of what you just described and figure out the tax side later, right? Because if I can get $20 million, I'll figure out tax on 20 million, right?
Good problem,
So
man.
yeah. And in this case, what you're doing is you're trying to stabilize your cash flow. So you're going to have this tranche that you receive up front by way of the sale, and it also depends on structure. So you have this lower amount that you receive up front from the sale. That's a lower capital gains tax that you'll pay, but also over the long run, you've now stabilized the cash flow because you've negotiated presumably a lower rent, or a reasonable rent, I should say it that way. So you've lowered your tax liability by having a smaller capital gain. You've also stabilized your cash flow a little bit by having a longer understanding of what your rent proceeds are going to be. Rent, that's tax deductible within itself, but that's really the play and the strategy there. But I gotta say, if I could sell for 20, I'm gonna take the 20 and figure out what I'm gonna do about rent later on.
So, and that's true. But if I look at this from a tax strategy standpoint, so I've depreciated this building out. I don't have a loan on it. I own it free and clear. So now every bit of income coming in is taxed to me, where now I can go, okay, I'm going to take cap gains on some of this. I'm going to have some recapture, and I'm going to take capital gains. I'm going to walk out the door. And now I've got $100,000 rent obligation, which is a deduction to the business and an ongoing expense. So I'm able to recapitalize myself, but it's not a refinance. I do have a capital gain event.
Right. And deal structure plays a huge role in this whole thing and how you exit, because depending on how you structure that exit, that capital gain may or may not impact you as much right away in year one. Things we've talked about on the show before, whether that's reinvesting in opportunity zones, structuring the deal by way of a DST, or some of those other types of exits, you can mitigate your tax risk right away in year one, or perhaps spread it over some time.
Neil, do you ever find yourself in a situation where you're buying a building and adding on to it, or building them a bigger facility because they've outgrown it, but their cash flow hasn't quite got there yet?
Yeah, I mean, quite often it's a way that we can really do hands-on value add to some of the projects. And again, it's not every tenant, but quite often what we see is when they get this influx of capital, we always will work with them and say, hey, where's this money going? Are you paying off some owner equity? Somebody's retiring, going to buy a yacht, or are you, typically paying down some debt, reinvesting in the company? And if it's the latter, quite often we see them really redirect that money out of the real estate into the operations, and they're able to grow the operations in a great way. A lot of industrial sits on, I don't want to say an excess, but more acreage than what you find in other asset types. It's very often, we'll have 300,000 square feet sitting on 25 acres or more. I mean, so an abundance of room to expand if needed. And a lot of these are, secondary cities in the Midwest where land is frankly just not that expensive compared to other markets. And when that happens, the terms of their lease say, hey, if they want to expand, they can, it's on their own dime, right? Or we can come in as a, what we like to refer to ourselves as really a full service landlord. We can say, hey, we actually have a development team in-house. We can do this for you. And we can find creative ways to finance the cost of this expansion. And that could be through taking additional debt from the existing lender. That can be through raising equity, sometimes a combination. And the end result, though, is we've usually pre-negotiated better terms on the lease and sometimes added term to the duration of the lease as well. So both of those are ways we're able to add very tangible value to our investment. The tenant is happy. They've just got a big old expansion. Our investors are happy. And really all that is tied intrinsically to the strength of credit of the company. If we see, hey, these guys are truly growing, they're not over leveraging, they're not, doing some financial manipulation to, try to throw a Hail Mary here, as long as their balance sheet can support it, and we go, hey, these guys are still, a very sure play to be able to stay in business and pay the rent, that's a win-win all day long.
Yeah. We're currently doing that right now with a group where they knew what size building they needed, but they didn't know the size of their operation inside, and they didn't know all of the equipment that they would need. And so we negotiated with them to capitalize that. And as if you can get a 6 cap on money expended, that's a pretty smoking deal, because you're able to expend $100,000 and turn that into a lot more in rent. So we did exactly that. We went in and we said, this is your building. This is what we can do for you. And they said, well, we need some TIs and we need this, but we don't know what that is yet. And we said, hey, here's a budget that really won't cover much. We'll put in an office and a bathroom, but from there you can expand it. And I think that they're going to, with floor coatings and everything, come in with about another $1 million that they're wanting to spend, that we get to then, again, like you said, recapitalize that at an even lower rate than what we negotiated the build-to-suit at. So these are great things. And Neil, where did you get this knowledge? Where did this information come to you that this was your niche and this is what you were going to pursue?
Yeah, I have to give credit to the founders, Dax and Andrew. These guys are both real estate pros. Dax has been doing this 25 years, Andrew about 20. So really, I was just fortunate enough to work contractually with them, about 8 years ago. Just really love the model, love the team. And it's a great full service team. And I'm just, had the privilege of being able to join. Awesome.
Well, Larry, do you have any more questions for Neil before I open it up to our live studio audience?
No, let's jump into the audience and tackle some of those questions.
Yeah, let's see who's got questions. Okay, so Rebecca's saying, can I do a 1031 from a multifamily into an industrial? Anybody?
It depends.
It depends. I knew both of you were going to say it. I was just going to see who was going to say it first.
That's the go-to right there, right?
So I'm very interested in increasing my investment in industrial. I don't think it's boring. Can I do this if I 1031 to more industrial?
I'd say if you're an active owner in multifamily and you're 1031 to an active ownership position in industrial, absolutely. And that would be a like-kind investment. Just the one caveat is you typically cannot go from a active ownership position to a passive interest through like a syndication, for instance. Those are usually not exchangeable.
Right. Now, Larry, when you paused on that depends, was your thinking the same as Neil's, or did you have a different depends?
Nope. It's the exact same. Oftentimes when you're in those passive structures, unless certain things happened and perhaps you break into a tick style structure or some type of direct ownership, you can't really transition from one to the other. Because when you think about it, like kind means property for property. When you're passive, you own a percentage of a partnership, not a property itself. So you definitely want to make sure you talk to your tax advisor before you attempt to do such.
Which is how I answered the question in the chat. I said, that depends, but call Larry. We hear this all the time, right? That, 1031 exchange, like for like, people want to 1031 out of, let's say, real estate, commercial real estate into a single family home for themselves or a vacation property for themselves. or, you know, a nice Ferrari or something like that. And those are definitely obvious no's. But, you know, like you guys both mentioned, it's always great to have a team of really strong advisors. Neil, we heard you say this. You've got strong guys on your underwriting. You've got, you know, your credit team. You've got a couple of guys in there that are doing the things that they need to on a very specific basis. And so that's always great to know. Let's see, we got another one here. Oh, Rebecca says, I'm going to call Larry. There you go. That's how that works. All right. Well, if we don't have any other questions, we'll go ahead and wrap it up. And thank you guys both for coming on our tax-free cash flow. We do like to have you guys go to our website at shannonrobnett.com, or you can go to Neil at shannonrobnett.com, and you can get directly connected to Neil and his group so you can find out more about them. And again, that's Neil at shannonrobnett.com. So if you'll send that on in, you'll be able to get connected. Larry, always good to see you, man. Neil, it's great to see you too. You look married.
I'm going to spend the rest of the day trying to figure out what that meant.
Yeah, well, you're going to go home and your wife's going to say, you better look married. You know? So, anyway. All right, guys. Well, thanks for showing up and providing the information, and always good to see both of you.
Thanks
Absolute pleasure.
All right. Thanks, guys, for showing up for Tax-Free Cash Flow. We'll see you next time.